Retirement Group. I am Samantha and I'm in Client Services. I moderate these weekly webinars. Today we're going to be speaking to you, ExxonMobil employees, about how to navigate retirement in current economic conditions. We're going to be joined in just a moment by Michael Corgiat, and he's going to be speaking to you and taking a tailored approach to managing your investments so you can prepare for a comfortable retirement. Before I bring Michael on, however, I'd like to just remind you that although we work very closely with both active and retired members of ExxonMobil, we are not affiliated nor endorsed whatsoever by ExxonMobil. The retirement group is a completely independent entity, so please do keep that in mind. And now that I've gotten all of the boring stuff out of the way, I'd like to introduce you to our speaker today, Michael Corgiat. Hi, Michael.
Hi, Sam, and hi, everyone. I appreciate you joining us today. Welcome. Today's presentation is going to be, I think, a very interesting one because of the environment that we're in. First, I do want to say a couple things about the retirement group. I am one of the firm's senior financial advisors. I've been a financial advisor for quite some time. We are an independent advisory organization. We do these on-demand webinars are just one of the many resources that we offer to help educate and inform individuals like yourself. As Sam mentioned, we work with the individuals, both active and retired, from a number of Fortune 500 companies. We offer a number of other resources that are available. We have retirement guides for all of the specific employers that we've focused on over the years. You just have to reach out to the office and we'd be happy to email you one. This on-demand webinar is recorded, so we maintain a library of all of our presentations. You could go to either our YouTube page or our website to view all of the pre-recorded webinars that we've done over the past several years. Obviously, we try to keep them up to date as well. We have an ebooks library that's filled with books on all sorts of great subjects. We maintain both a blog and a newsletter. Any information you want, all you have to do is go to our website, theretirementgroup.com, or you can email us at info@theretirementgroup.com. So let's go ahead and get started. Why do you want to consider the retirement group? Well, we are a team. We're proud of that. We work very closely together and we've got an awful lot of experience. We have offices nationwide. My partner and I are based here in St. Louis, and I have clients all over the United States. We have a great deal of knowledge on all of your 401k programs, your pension plans, as well as many of your other benefit programs. And then finally, something we're very proud of, a resource that we offer, and it's a complimentary service, is our retirement cash flow analysis. Please take advantage of this. It's a great snapshot of your current financial situation, and it'll give you an idea where you stand for your retirement, whether that retirement is a month away, a year away, or 5 or 10 years from now. It is complimentary. All you have to do is ask for it. We'd be happy to put one together for you. I think you will find it very helpful. One thing I always like to say is that individuals and couples that start planning early, the sooner you start planning, the better off you're going to be when retirement rolls around, especially in the environment that we all work in today, when your employers are constantly downsizing their employees. And on any given Friday, you might get an email saying, hey, we no longer need your services. Here's 6 months severance and we'll see you later. Bye. So again, take advantage of this resource. We'd be happy to put a cash flow analysis together for you. A little bit of the agenda today, talking about high government spending and taxes, inflation, interest rates, and then some of the opportunities that all of this chaos has created for all of us in today's environment. First, let's just capitalizing on the market slowdown. We're going to talk about our philosophy, which is a value-oriented investment philosophy. We'll compare value stocks and growth stocks, and a little discussion on the differences between the two, and then give you an example, a simple example of a value philosophy. So our value philosophy, again, is value, more conservative investment orientation when it comes to equities. All right. Value stocks are not as volatile as growth stocks are. And we'll talk about prior performance here in a moment, but what is a value stock? What is a value company? Well, value stocks are solid companies that are typically trading below their intrinsic or their actual value. So a business that is trading, their stock is trading at less than what it truly could be worth if it were to be parted out in a sale. Value companies traditionally have lower price to book and price to earnings ratios. Most value stocks, value-oriented companies, pay some kind of dividend. Whether it could be 1 or 2%, it could be high as 7 or 8%. All right. But most of them do. They take their earnings and they share them with their stockholders. And finally, identifying great money managers. I'm going to talk about Warren Buffett here briefly. Warren Buffett, founder and leader of Berkshire Hathaway, which is one of our favorite value investments. Warren's been around for 55, 60 years now. He's got a tremendous track record for picking undervalued companies and building the Berkshire Hathaway portfolio with 50 or more different businesses. He either owns a lot of stock in many of these companies, or he actually owns the company, like when he bought Burlington Northern Railroad. And it's done very well for Berkshire Hathaway shareholders. A couple of bullet points to consider with value stock investments. You can avoid permanent loss of capital with undervalued value stocks. This helps you to identify what we call a margin of safety. Essentially, the intrinsic value of a company could, let's say, be worth $50 a share. That's the overall value of assets minus liabilities. But the stock is trading at $30 a share. The margin of safety in that particular investment is $20 a share. You've got a lot of opportunity for upside. And it definitely reduces your downside risk. All things to keep in mind. Value stocks versus growth stocks. The first graph, this is a historical graph of value versus growth. Value is the purple. The growth stocks are the orange line. This goes back almost 30 years. And as you can see, it's up and down, up and down, up and down. The average rate of return between value stocks and growth stocks is less than 0.25% over this 40-year period of time. It's just that you got there with less volatility considering value stocks versus the more volatile growth stocks. And then this next slide talks about, this is just a perfect example of how volatile growth stocks are. Last year, value stocks were down a lot less than growth stocks were. The Vanguard Value Index, the VTV ETF, was down less than 5% last year, whereas the NASDAQ 100 growth market was down 35% last year. That's the difference. That's the roller coaster ride. That's the significance of the volatility between growth and value. Can you stomach this kind of volatility? Well, hey, if you're not anywhere near retirement, maybe it makes more sense. But most of the individuals and couples that we work with are closer to retirement and don't want this kind of volatility in their retirement asset portfolio. A quote by Charlie Boborinsky, I never get his name spelled right, but Charlie is one of the founders of the Ariel Investments Fund, and he's been in the business for over 40 years. Simply stated, you could go back all the way to the Great Depression in 1926, and value has beaten growth stocks for every rolling 10-year period of time, except for the last 10 years. So value historically has done better than growth, except for in recent history. That doesn't mean it won't change, but I have a good feeling, and more than likely it will reverse to the mean and value will become a smarter, longer-term investment versus a year-to-year type of investment, which is what growth stocks and how growth stocks are looked upon. Here's a simple example of a value philosophy, and it's just thinking about buying a stock is like buying a small business. Here we've got a flower delivery business that's for sale. The business is, business owner's asking $200,000 for the business, all right? Book value is assets less liabilities. Business has no debt. He owns 5 delivery trucks that are worth $160,000. He's got inventory of $10,000, so the book value of the business is $170,000. I'm going to pay $200,000 for it. But bottom line, the most important thing is this business generates $30,000 in free cash flow in any given year. And that's a 15% rate of return on my $200,000 investment. That's a value stock. That's a value business. It generates a lot of free cash flow. It can pay dividends as well. And it just makes more sense. I like to say value investments are more of the older economy companies that have been around forever. And growth stocks are much more of the newer economy companies. Not all of them, but many of those newer economy companies. Let's switch gears now. First, just touch on what is a recession and how is this potential recession, don't want to say we're in one, was created. Well, a lot of it started with all of the high government spending that both the U.S. government as well as the Federal Reserve pumping in trillions of dollars of liquidity during the COVID era. It's hard to believe it's been 3.5 years since the whole economy shut down in March of 2020. 3.5 years later, we are, and our economy is extremely strong now. But it's gotten so strong that we've got some pretty significant inflation. And last summer, core inflation peaked out at over 9% year over year. What is a recession? Well, the Federal Reserve has been trying to slow the economy down. And by slowing the economy down, you can potentially cause a recession. The Fed has raised interest rates, and we're going to talk about that here in a few minutes. Raising interest rates, its intention is to slow the economy down, to get individuals and businesses to spend a little less money, and inflation will come down. And inflation has come down. Core inflation is almost 4% now, down almost 5 full percentage points over a little more than a year's period of time. But a recession, as you could see here, is defined as 2 consecutive quarters of negative GDP. We have not seen that yet. And there's a very good chance we will not see any negative GDP in the near future. I'm not a genie. I can't predict it. But based on everything that I read and everything I follow and people I talk to, it does not look like our economy is going to go, quote, into a real recession, although it will and is probably slowing down. And what the Federal Reserve is doing with interest rates is working to bring inflation down. So if we can get inflation down without going into a recession, that's a win-win for all of us. But talking about different kinds of bond investments, we'll start with U.S. Treasuries. Obviously, U.S. Treasuries are issued and backed by the full faith and credit of the United States government. All the bonds are issued by the Department of the Treasury. Investors love Treasury bills, bonds, and notes when things get difficult, when a recession comes about, because they are safe, as is probably the safest investment you can think of, and they pay good interest rates right now because interest rates are higher. So a lot of investors favor Treasuries during these difficult times. And people have sold out of equities and bought more Treasuries, primarily because of that safety, as well as the higher yields, which I'll talk about here momentarily. You've also got municipal bonds. Municipal bonds are typically issued by state and local governments or municipal organizations. They are typically backed by the full faith and credit of that taxing entity, whether it's a city, state, or county, whatever it might be. Municipal bonds are tax-free, so you do not pay federal income tax on the interest that you earn from muni bonds. And if you buy both federal and state tax-exempt munis, you don't pay state income tax either. They are typically lower rates, but that's because you don't pay income taxes at the federal and state level. They're not backed by the full faith and credit of the United States government, so they are a little riskier. Got to keep that in mind. And let's talk about corporates. Corporates bonds are taxable at both the federal and state level. These bonds offer greater yields, but they also offer a little bit more risk because they're issued by corporations. Now, there's a lot of great corporate bonds out there because there's a lot of great corporations out there. You want to consider, when you do invest in corporate bonds, looking for higher quality, AAA, double A or single A ratings versus higher yield, which is triple B or double B and lower in the bond hierarchy. So higher rated, higher quality bonds are going to be safer when issued by these corporations. The benefits of bonds in general during a recession, I've talked about most of that, but bottom line, bond investments do one thing that a lot of other investments don't do, and that's give you a steady stream of fixed income based on whatever the coupon rate is on a bond. If you buy a 4% 10-year treasury right now, you're going to get 4% until that 10-year treasury bond matures. Come hell or high water. The underlying value of the bond goes up and down based on what interest rates do. And bonds become more in demand because stocks during a recession, well, it's a little riskier. All right. Now, good businesses are going to get through recessions, but businesses that are in a lesser state, all right, they're just not as solid a company, or they've got a lot of debt. You might want to stay away from those sorts of bonds. I guess I got ahead of myself here, but a corporate bond that proposes more credit risk is the higher yielding, more indebted companies out there, or many of these bonds used to be called junk bonds. We like to refer to them as higher yield bonds. They pay a higher coupon. They're lower in the capital structure of a business. You got to keep in mind that corporate bonds are secure, more secure, because they are ahead of stocks in times when a business might go out of business and be liquidated. So bonds are ahead of stocks in that scenario. So keep that in mind. And as far as bonds in general, again, you want to invest in higher quality corporate bonds just because there's a lot less chance that the underlying value of those bonds is going to decrease or essentially default. How to manage bonds in a recession? Well, bond duration, that's a big deal. Bond duration is essentially, I talked about a 10-year treasury. A 10-year treasury has a duration of 10 years. A 2-year treasury has a duration of 2 years. A 30-year bond is 30 years. During times of recession and times of volatility, you want to shorten your duration and invest in bonds that are, let's just say less than 5 years in duration. The underlying principle or the value of the bond is affected by interest rate movements. And the longer the duration on any bond is, so the difference between a 10 and a 30-year bond, that's a lot of duration difference, 20 years. Interest rates have more impact, both when interest rates are going down, bond values go up. Think of it as a teeter-totter. And when interest rates go down, and interest rates will eventually go down again. Once the Fed's done raising rates, they're going to have to lower them eventually to get back to normal. Underlying bond values will go up. There's a tremendous opportunity in overall bond investments right now because we all believe that the Fed's almost done. Hopefully, they may already be done raising interest rates. The federal funds rate is at 5.25%, may go a little bit higher. But once the Federal Reserve is done raising rates, the bond market in general, both treasuries, corporates, and munis are all going to settle down. And once the Fed starts to lower interest rates, underlying bond values are going to go up again. Last year, bond funds got beat up just like equities. They will go up in value. It will be a good investment, both for the coupon as well as the appreciation. So best way to invest in bonds, in our opinion, is to use mutual funds or ETFs because you're buying a diversified portfolio of bonds, just like you would be with stocks. I like diversification. And choose quality over quantity, higher quality over quantity. Here's some recent interest rates on the Treasury. We've got old double E savings bonds at about 2.5%. Series I bonds or inflation-rated bonds are currently at 4.3%. 30-year bonds and 10-year notes or bonds are both at about 4.5% now. These interest rates are just a little outdated, but they are definitely close. And here's a history of I bonds. I bonds have become a lot more attractive to business owners and individuals now because of inflation. Back in 2022, last year, you could see I bonds were paying upwards of 9.5%. November of last year, it adjusted down. These rates are adjusted every 6 months, almost said years. And right now they're at 4.3%. You can buy I bonds on treasurydirect.gov. So that's where you want to go to buy I bonds. You can buy all treasuries on that website as well. Here's a graph of the yield curve for treasuries for the past 4 years. The red line is the current yield curve as of June 30 of this year. And the yield curve is currently inverted. Why is that? It's because short-term rates are very high, but the market knows that longer-term rates are going to come down when the Fed decides to lower rates. But as you can see, all interest rates currently are higher. The green line is last year, and then the other two lines are where we were the previous 2 years, where rates were darn near insignificant. Because of COVID, the Fed chose to lower rates to near zero and left them there for quite some time. It's unfortunate that all that liquidity that was available to the markets wound up boosting spending, especially after we got through the first year of COVID. Everybody wanted to buy everything once we got all the supply chain issues worked out. And almost all products and services jumped very quickly. As I'm sure you're well aware, when you go to the grocery store or pay your utility bills or even try and buy a new home right now. All right, now let's talk a little bit about various rollover strategies with your qualified retirement plan assets. First, if your employer offers a lump sum option for your pension, and many employers do, what do you want to do with that pension lump sum? And also, what do you want to do with your 401k? Well, you definitely want to keep that tax-deferred status of those assets. And it's smart to roll all those assets over into an individual retirement account and out of the corporate plans. You control an IRA. You definitely control the investments, which is where certainly we can help as well. And there's no taxes based on the rollover. You're only taxed on withdrawals from your IRA or any qualified plan assets when you take money out of the IRA. And you can have taxes withheld. There are also potential penalties if you withdraw money from your IRA prior to 59 and a half, or in many cases prior to 55 if you have a 401k balance. This is a little discussion on the spillover, or what we like to call the spillover IRA. What you see here is essentially you can put up to $30,000 a year into a 401k. $22,500 is the max if you're under the age of 50. And then you could do a catch-up contribution of an additional $7,500. But many employers allow you to put more into your 401k. And in this case, this year, you could put up to $66,000 without the catch-up or $73,500 with the catch-up. So for those of you who can afford to set aside more money for your retirement, you could put after-tax money in as well as the pre-tax money. The after-tax money, obviously you've already paid taxes on it, but annually you can take those funds out and roll them into a Roth IRA. This is an indirect way to contribute to a Roth IRA. And then from that point forward, those dollars grow tax-free. You'll never pay taxes on any of the growth in those assets. Not all employers offer this. Several of them do. Reach out to the office. We'd be happy to tell you if your employer does or does not allow this particular opportunity. But it is definitely a great opportunity if you can afford to set more money aside. So I've talked about a lot today, and I do really appreciate everyone's attention. I'll circle back around to having a plan. 75% of Americans over the age of 50 don't have one. I used to quote a statistic, and I think it's still true. Many Americans spend more time planning a 2-week vacation than they do their own retirement. So take advantage of that, of our complimentary retirement cash flow analysis. Let us put one of these together for you. All right. You could schedule a meeting by scanning the QR code here on the left. You could schedule a meeting with myself or one of my colleagues. You could definitely check out our LinkedIn page by scanning the QR code on the right. I mentioned our email address earlier, info@theretirementgroup.com. And you can phone our office at 1-800-900-5867. So with all that said, I hope this has been helpful and interesting. I'm very passionate about a lot of these things, and I love talking about them. So I'm going to go ahead and hand the presentation off back to Sam and see what kind of questions we've got. Sam?
Hey, Michael. Yes, we got quite a few questions. We're going to try to answer as many as we can, time permitted, obviously. This first one, Michael, why are value stocks often more resilient than growth stocks in times of high inflation?
That's a great question. Value stocks are obviously older economy type companies that have been around for a while, companies that are well established. That's a key. Businesses that are well established can do better and have less issues during volatile times, whether it's inflationary or high interest rates or both. So they have historically always been stabler investments than growth stocks, especially during difficult times like what we've been through the last couple of years.
All righty, thank you. Okay, number 2. Are value stocks suitable for retirees?
Oh, definitely. As I mentioned earlier, we here at the Retirement Group focus more on value investments than growth stocks. Not saying growth stocks are bad, but I personally just like less volatility, more stability with value investments. Value stocks pay dividends in many cases. It's just, they're better off for people because, think of that slide I showed you where the value index was down 4.5% and the growth index was down 34%. What if you retired at the beginning of 22 and had all your money in growth stocks? Could you stomach a 35% decline in your portfolio? I don't think so. I know I don't want to, and I'm still working. So value stocks are definitely stabler investments, and they do pay income in many cases while you're waiting for the appreciation in the underlying price of the stock.
Alrighty. Number 3, considering I'm nearing retirement, which investment strategy, value or growth, is more suited to protect my capital while providing growth?
That's another great question, and just another reiteration of what I've said already. If you're nearing retirement, you're going to want stability, and you're going to want your portfolio to also try and help you generate income. Between value-oriented equities and fixed income investments, you'll solve all those issues. Less volatility, more stability. I'm not saying you don't have investments in growth stocks. Even within our models, we do have investments like the S&P 500, which is a blend of both growth and value. We have those kind of investments in our client portfolios, but everything does lean more towards value because of income and stability, and it's an easier roller coaster ride is value.
Alrighty, we're going to answer one more. We're running out of time here, Michael, but
Okay.
We'd like to remind you guys that if you have any questions we did not get the opportunity to answer today, please feel free to use that link and book an appointment with Michael or one of his colleagues to speak further on any concerns you may have. Michael, last one. How do value and growth stocks typically respond to economic downturns, and how can I ensure my portfolio is balanced to handle potential future recessions?
That's another great question, and I'll refer to the slide where I showed you where value was down 4.5 and growth was down 35%. In volatile times, people will flee growth stocks and go into treasury bonds and value-oriented investments. It's simply, I can't say it enough, working with retirees for the past 30 years, I personally like to sleep at night as well as I want my clients to be able to sleep at night. And value-oriented investments are just less volatile. Businesses are more stable. A lot of these stocks pay dividends, so you get paid while you're waiting, whereas growth stocks don't. All right. Growth stocks are typically, like I said, newer economy, leading edge technologies, these sorts of things. Yeah, everybody wants them in the beginning. But I'll tell you what, in tough times, recessionary times, high interest rate times, Lord only knows what the next geopolitical risk is out there. I mean, heck, there's a war that was started 18 months ago in Eastern Europe. You just never know. People will want to run away from growth stocks and they will go to value just because of the stability. So I hope that helped.
Thanks, Michael. That was all we had time for today. Do you have any closing statements before we go?
I really appreciate everyone's attention today. I hope this was helpful. I'd look forward to speaking to any and all of you at any point. But we here at the Retirement Group really look forward to helping anyone who would like some help. Just reach out to our office. Thanks and have a great day.
Thank you. Thanks, Michael.